Yo, what's going on, boys? Welcome back to another video. Today's training day 21, and today's entries part 3. So in entries part 2, we were going over 15-minute liquidity sweep, 5-minute breakup structure. We are going to be adding one more confluence to that, which is a fair value gap retrace. So in entries part 2, you would start with determining your bias, and if you were bullish, you would wait for 15-minute lows to be swept. And if you were bearish, you would wait for 15-minute highs to be swept. And then, after that, you would wait for a 5-minute breakup structure. We're just adding another confluence to give us more confirmation. So, we're going to do the same thing. We're going to start on the 4-hour. Well, we're bearish. We're bearish. What else do I see? 1-hour inverse fair value gap. What else do I see? We're respecting this fair value gap well. I'm probably bearish in this situation. Then, what do we do whenever we're bearish? We wait for 15-minute highs to be swept, which we had right here. 15-minute high swept, and you'd be like, you might be saying, oh, this is at 11. Okay, this is the only setup we had this day. You say, oh, we had a liquidity sweep here. Go down to the 5-minute, we didn't have a breakup structure. You don't know what you're talking about. Watch it. So this liquidity sweep over here didn't lead to shit. So that's why we're going over this one. We have 15-minute liquidity sweep. What do we do from here? Say it with me. Scale down to the 5. What are we looking for? Say it with me. Break of structure. Okay, awesome. So, where's our most recent low? Right here, because we look at our most recent low whenever we're in an uptrend. Whenever we're in a downtrend, you look at your most recent high for a breakup structure. Simple? Alright. So, now, oh, whoops. We're going to wait for a closure below our most recent low, which is now up here, so we put in a new low. Bam. And now, in entries part 2, you would enter off this. This is entries part 3. So what do? Instead of entering off that, we go to the 1 minute, and we mark out the fair value gaps that we see. There is 4 here, I believe. Yes. We're going to enter off of a retracement of one of these. So, let's go forward a little bit. It's on the 1 minute. Oh, we see we instantly inverse this. I wouldn't enter off this. I want to see like a wick tap into one of these. Or I just want to see us respect one of these. We just disrespected this first fair value gap. So I wouldn't enter off this retracement because we just straight up disrespected this. I would like to see us respect one of these fair value gaps, then I would enter off this. And you may be asking yourself, why do we enter off a 1 minute invert or a 1 minute fair value gap instead of just the 5-minute breakup structure? And that's because we want to get a better entry. For example, I'll go back real quick, then we'll go back to the 1 minute. Let's say I entered here, press sell, stop loss above the liquidity sweep, $136 for my stop loss, right? So remember that number, 136.5 USD for the stop loss if I entered off the 5-minute breakup structure. Now let's go back to the 1 minute. And let's enter off a fair value gap retracement. Bam, right there. You could enter here, you can see we respected this fair value gap pretty well. Sell, stop loss above here. And look at that. What's our stop loss at now? $81 instead of $136. Okay. Now from here, what do? We pull out our short position tool after placing our stop loss. Bring their stop loss, or bring the red to your stop loss. Hold on, let me get rid of these. Jeez Louise. Get rid of these. Now let's see where 1 to 2 is. I'm actually going to go to the 5 minute. See where 1 to 2 is. 1 to 2 is right here. Is there 15-minute lows near there? There is. I'd probably put my take profit right on this 15-minute low right here. So we'll drag this down. Bam. That's a really nice risk to reward ratio. 2.48. Let's make this a little fucking bigger here. 2.48 risk to reward. We're risking 81 to make 250 cents. And it smacks. That's why you put your stop loss above the liquidity sweep. And yeah, come on. There we go. There we go. There, it's a great example of how to use fair value gap retracement alongside 15-minute liquidity sweep and 5-minute breakup structure. And again, why do we enter off of 1-minute fair value gap retracement? To get a better entry. Right? So that way we're risking less and we're still making the same amount. Who doesn't want that? Who doesn't want that? So, relatively short video, but I don't want to confuse you guys too much. This should be relatively simple. If you've been watching all the way through from day one until now, and you've been taking notes about every single topic that we've learned, this should be an absolute breeze. Absolute breeze. If you've been doing absolutely everything I tell you to, this should be an absolute breeze. But if it's not, don't worry. Everyone learns differently. There's no reason to freak out. Okay? I want you guys to go into the charts and practice this. Go to the 1 hour. Determine what trend the market's in. If it's bearish, look for 15-minute highs to be swept. If it's bullish, look for 15-minute lows to be swept. Then, after you see a 15-minute liquidity sweep, wait for a 5-minute breakup structure. After you see a 5-minute breakup structure, wait for a 1-minute fair value gap retracement. And we honestly could have got a way better entry too. Like, we could have waited until we respected this one. Like, imagine. So what did we risk? I think we risked $81. Let me just go back to here, because there was still fair value gaps above us whenever we entered. There were still 2 more big fair value gaps above us. So if I would have entered here, stop loss. Wait, why is it putting me in down there? There it is. $43. Let's just put our take profit to the same 15-minute low. Goes down here. What do you think? Let's look at this risk to reward. Let's look at this risk to reward. Oh my god, turn off the magnet this instant. Bam. 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 5.53 risk to reward. So, if that's something else you can do, is if there's like 4 fair value gaps in a row, you don't have to enter after seeing the first one get tapped. Because like we instantly inverse the first one. Then we did respect this fair value gap, so this was a smarter entry. You could have waited for this to get hit, but I think the smarter entry was our original entry, this candle right here, because we respected this fair value gap, and we could have just went down from there. But if you want to, you could have waited see if we were going to tap into these, because we did still have both these fair value gaps above us. And you would have got a way better entry, risking $40 to make $240. And there it goes. We know it already hits. That would have been an absolutely banger trade. Okay? So again, hopefully you guys learned something. Hopefully you guys took notes. And yeah, man. Next video will be back on psychology. And yeah, I'll see you boys on Tuesday. Psychology. Hopefully you guys took notes. Alright, I'll see you boys later. Peace out.